Broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from the 2017 webinar surveys. So watch for your question that you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to answer questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, one for each month. And who knows, maybe one lucky viewer will have a chance to win a 20th anniversary gift from LLIS. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA and has been leading LLIS as president and CEO since 2013. And here is Mark Maurer.
Thank you, Claudia. And for anybody who's tuning in, and I got to see you last week in Philadelphia at the NAPA conference. It is much warmer here than it was there. But it's Florida, what do I expect? So today what we're going to talk about are 20 different insurance-related acronyms helpful to pretty much everybody. I'm sure as in your businesses, there's lots of different abbreviations, jargon that you try to remember not to use necessarily the first time you're speaking with a client. Same thing in our world. You get used to saying things like APS or MIB, and remember that it's something that we use every day, but not something that everybody's used to every day. So I'm going to go over 20 different things that, as Claudia mentioned, either may have been something that was requested by a specific advisor, things that I've found over the last few weeks that I thought would be maybe good to go over. The first one is asset-based care, and this is a pretty big topic conversation. This can actually be a full-on hour webinar, but we're not going to do that because I have 19 other things to do. But asset-based care in its purest form or simplest form is just a way to combine long-term care benefits on top of either a life insurance policy or an annuity policy. So,
hold on, Mark. Sorry, I don't see your screen. If you can just make sure that you're showing your screen.
Show my screen. There we go. Is that better?
Yes.
All right. Thanks, Claudia. Glad you're paying attention. And let's see. Now I lost my train of thought. There we go. So that's what the asset-based care does. So there are a couple of different types. There's life insurance on a long-term care on a life insurance chassis, and it can be done a couple different ways. It can be an individual policy, so it'd be on one person, and you can build in lots of different options onto this particular policy. You can add inflation options or inflation riders. You can have a return of premium feature built in. Many of these policies offer discounts if you have a spouse or a partner who's applying. And so the premiums will be lower if a married couple is applying, for example. And what's attractive about the life long-term care hybrids is that it has some guaranteed features that aren't built into a traditional long-term care policy. Now, a traditional long-term care policy has great features too, but it's guaranteed renewable. So premiums can increase on a statewide basis. Insurance companies apply to the different states, request increases, and so that the rates can change there. But the life long-term care hybrids offer a few different designs and components that end up being guaranteed. So there's a death benefit that's guaranteed if the policy is never used for long-term care benefits. So that's a nice feature. If you put in $100,000, there's probably $120,000, $130,000 death benefit that goes to somebody if it's never used for long-term care. There's cash values. Again, with the return of premium option, you can have a 100% return of premium after a certain period of time, or sometimes even day one. There can be an 80% return of premium. It just depends on the company and different options. But you also have fixed long-term care benefits. So when the policy is set up from day one, you know exactly it has a 4-year benefit period, $5,000 a month, growing at 3% compounding. And we're going to know exactly what it is. There's no fluctuation, there's no rate increases, there's nothing that's going to change on the policy. So that's a nice feature of that policy. And again, if anybody has any questions, please feel free to put them, type them right there in the question box. Now, with the ABC policies, you can do a joint or second to die. Some policies have inflation, some don't. Some are going to have cash values, some aren't. So sometimes this is a no-lapse guarantee policy, sort of a fixed death benefit sort of design, no cash values long-term, but designed more for the long-term care, the life insurance component. Then you can add other policies that even include a lifetime long-term care benefit option. So if neither spouse used the policy for long-term care, there will be a death benefit that passes at the second death. So really designed for a legacy to children, a charity, something like that. But if they need it in life for long-term care, then both spouses can actually be on claim at the same time and have an unlimited benefit period. So let's say it's a $100,000 policy, the long-term care benefit rider provides $4,000 per month. Both spouses could be on claim at the same time at $8,000 a month, and each one can use it for as long as they need it. Or we can add long-term care benefits on top of an annuity. Similar to the life insurance, it can be a single or joint, or include two people. This one is always going to be a single premium, where with the life insurance options, you could do a single premium or you could do a short pay, annual premium for the rest of the client's lives. Lots more flexibility there in the funding. Now, how do we find a solution if there's only one spouse who has the life insurance? Traditionally, in order to do a 1035 exchange, you have to have like owners to like insureds. And so you couldn't do a 1035 exchange from a life insurance policy on Steve to a second-to-die policy on Steve and Cindy. But with the annuity, we can still do the exchange to an annuity that Steve owns, and Steve is now the annuitant. However, we can add Cindy on as an eligible person to receive the long-term care benefits. So this is a really neat option in that with life insurance, a pure life insurance policy, you couldn't move from a policy on one person to a policy on two. And here, really, it's an annuity on one to an annuity on one. But with the new annuity, we're adding long-term care benefits on two. So this is a really neat option, really neat part of the design that I think really is neat, and it's a planning design that I don't know that a lot of advisors, clients know is out there. But when we have one client with possibly an annuity and the couple needs long-term care, that's a part of their planning that's that you're recommending they work on. It's a neat option to be able to fill that gap. All right, number 2, accelerated death benefit. These are parts of a life insurance policy that allow the acceleration of the death benefit. I mean, that's pretty much what it is. But it's a way to give some of the death benefit to the policy owner in advance if certain things happen. And the original version of this were the terminal illness riders. And these came about because you had probably got the most notoriety during the 80s with the AIDS epidemic, and people who were selling life insurance policies for very, very low amounts, sort of predatory purchasers who were buying life insurance policies from terminally ill people, giving them not much money, and then collecting the death benefit later. So came up with a protection through the insurance companies in different states to say there's got to be a better way to do that. So within most life insurance policies, and depending on the states, there's a terminal illness rider. And depending on the company, if a doctor certifies that the insured has anywhere between 12 to 24 months left to live, then the policy owner can get part of their death benefit early. So it's really a prepayment of the death benefit. It's not normally a loan. If it's $1 million policy, then you can accelerate part of that death benefit. And again, from the insurance company standpoint, they're assuming they're going to pay it out in the next 12 or 24 months. And usually within the contract, it defines how much can be accelerated. Normally, a percentage not to exceed a certain amount. So it may be 50% of the policy amount not to exceed $500,000. So if you had a $10 million policy, the maximum acceleration would be $500,000. If you have a $250,000 policy, could accelerate the 50% or $125,000. So this is something that's built into most policies, but it's rarely used. It's probably not that common to have a doctor who's willing to certify that somebody has less than a year to live, because with what we can do with medicine today, you never really know. But more common, it will be more commonly used, so I take that back, more commonly used, but not necessarily more common to have on policies, would be a critical illness rider. And sometimes you can add these on for an extra premium onto policies. Sometimes it's built into the contract. More often it will be built into the contract on a permanent policy than a term. But some term policies you can't add this as a rider. Sometimes it's built in. And it will allow the policy owner to get part of the death benefit early for a critical illness. And those are going to be specifically defined in the rider language. Something like a heart attack, stroke, major organ transplant. And it's usually pretty fairly defined in the policy how much you can get. Where terminal illness may be 50% of the death benefit up to $500,000. Critical illness may be 10% of the death benefit, not to exceed $50,000 or $25,000. Usually a much smaller number, because with terminal illness, the insurance company expects that there will be a death benefit the next year. So they may be willing to give out more of the death benefit early, knowing that they'll have to eventually pay it out very shortly. It's very possible you can have a stroke, heart attack, get some of the life insurance, and live for a number of years. So the critical illness has these defined events and smaller amounts that you can accelerate from the life insurance. The third layer is the chronic illness. And this usually has a dollar amount, percentage amount between the terminal illness, which is going to be the largest, and the critical illness, which is going to be the smallest. Again, if you have a chronic illness, you may not pass away in the next 12 or 24 months, but it may not be near as long as if you've just been diagnosed with breast cancer, something like that. So chronic illness, how do these get triggered? Very similar to the language of what triggers a long-term care policy. You have the inability to perform 2 of the 6 activities of daily living as defined in the policy. Or you have a severe cognitive impairment that would require substantial supervision for care or safety. And again, those are very similar to long-term care triggers, and you can accelerate part of the life insurance, again, if your policy has these chronic illness riders attached to it. Now, speaking of activities of daily living, we're going to talk about those because that's another A. So that's number 3. And again, activities of daily living, being unable to perform 2 or more of those activities of daily living is one of the triggers to qualify for long-term care benefits or, as I mentioned, from the acceleration from a life insurance policy. So what are those 6? Bathing, continence, dressing, eating, toileting, and transferring. So if a medical professional certifies, or I guess in their opinion, that someone is unable to or has been unable to do 2 or more of those independently for 90 days, or they don't expect you to be able to do it for 90 days or more, then that person would be eligible for benefits under either a traditional long-term care policy or under one of the, or accelerating one of the life insurance benefits. Number 4, AIM. It's our application information messages. And so these are notes, messages that you get, that your clients get, and these are just to keep you in the loop along the way as your clients are going through the insurance application process, whether it be life insurance, disability, long-term care, annuities, just designed to keep you as advisors in the loop along the way. And another way to keep you in the loop is through LLIS. So our online advisor portal where, as you can see, this is Joe, the advisor, can see different information about clients, where their policies, applications are in the process, get policy annual statements through the files there on the right, and you'll see a list of clients and where they are in the process. So again, all things designed to help you and help your clients and give you, even if we're not here, the ability to go online, take a look, and see the progress of clients' applications. And one other thing that we designed a number of years ago is our advance premium email. And this was requested by an advisor because she'd had a client who moved, and along the way, and the premium notice went out, and they'd moved, so it took a while to find where that had gone, and worked on getting the policy to prevent it from lapsing. And so we built this, our APE system, to give advisors and clients a heads up that they're going to have a premium due soon. And it may help if somebody goes on a cruise and is going to be gone for 3 weeks. Just the ability to say, oh yes, I know either A, I need to do that right when I get home, or let me go ahead and get that set up and can talk to one of our policyholder service team members here and find the information and get all that going ahead of time. Another thing it really does, and I think probably it's half of what the APEs are or responses we get are for people who've moved. And again, it just helps us keep our system up to date. And then if we don't, what we can do is we can take that information and relay it to the insurance company so that the premium notices that go out from the insurance company also go to the right place. Number 7, ART, annually renewing term. When I took the CFP course, this was the lowest or lowest premium option of any life insurance policies out there. And sometimes it still is in the short term. And sometimes it's even not in the short term. Sometimes you may find insurance companies who have maybe a 10-year term policy that's lower than anybody else's ART that increases every year. It just depends. But what is ART, annual renewing term? The premium for this term policy is going to increase every year. So renewing, increasing. Usually, the first 5 years of the increases are fixed. So we know exactly what they're going to be for the first 5 years. After the 5 years, though, then usually there's two rates. There's a projected or an assumed increase, and then there's going to be a guaranteed increase. And usually the projected looks very similar to the other increases. The guaranteed usually jumps 3, 4, 5 times after 6 years. So going forward, we know exactly what the increase is going to be for the first 5 years in general. In year 6, you're never really sure. So ART tends to or can, look good for the first 2 or 3 years. Often it will have a lower premium than anybody's 10-year term. But it's not good long-term term. It's not a good long-term term policy. Those annual increases just keep going up and up and up. And so even if it's lower for the first 2 or 3 years, in year 4 or 5, it's already higher than what a level term policy would have been, and it just keeps going and going and increasing. And a lot of times it's just an entree into converting to whole life, because the annual term will go up and up and up. And then, and I've seen this many times from your clients who have 6 or 7 $50,000 whole life policies. Why? Because they had an ART policy, the premiums kept going up. But whole life has a fixed premium, it's level. So the idea is that as the ART goes up, well, we can convert pieces of it into the whole life. And even though the premium is a lot higher, it's level. And so people do that. So just to take a look, here's Chip. He's age 45. For a $500,000 policy, assuming he's in best health, I looked at an ART premium and sort of how their projections are going to go, and compared it to a 10-year, 15-year, 20-year level premium. So as you see, the ART is the lowest premium in the first year. It's the lowest premium in the first 2 years. But in year 3, the ART premium is already $325 a year, and the other insurance company's 10-year term was $322. So can pay the $322 for all 10 years, maybe paid more than the ART for the first 2 years, but look out at year 10. The ART premium was projected to be $695 compared to the 10-year term that had locked in $322. In year 15, or for the 15-year term, the 15-year term, well, the 442 is higher than the ART for the first 5 years. But look at that last year. If the client really does need it for 15 years, the 15-year term is still 442 that last year, where the ART is projected to be 1950, 1,950. Now, why is it really not good long-term term? Take a look at that 20-year. $569 a year, locked in for 20 years. In the 20th year, the ART is projected to have a premium of $10,000 just for 1 year. So short term, comparing the 10-year to the ART, 10-year still looks a lot better, but 695 to 322, that's not near as bad as taking a look at that 20-year term and seeing $10,000 for 1 year compared to being able to have locked it in for 569. So not good long-term term. APS, attending physician statements. This really is one of those insurance acronyms that we use regularly and try not to, but it's what we get from the insurance companies. It's a word they use or acronym they use. So we try to remember not to use it here, but it's just something that's used so often. I know I mess up every once in a while and try to remember what it is, but it's doctor's records. APS, attending physician statements. It's not something that they're writing to say, I saw Mark last week, he's in good health, he's tall, nothing like that. Attending physician statements just means your doctor's records, nothing that they have to do or create doctor's records. Fancy name, again, something we don't use every day or hear every day, just means doctor's records. BOE, business overhead expense. So for any of your clients, well, pretty much all of you, you know that your ability to keep your office running and business running depends on your ability to earn income, to have money coming in the door. And what do you do with that? Well, you pay your salary, hopefully, but then you have all the other things that the business pays for, your bills, other people in your office, rent, all of those things are expenses to keeping the business running. So business overhead expense is a type of disability policy that would reimburse a business for those expenses if the person who's responsible for generating the income isn't able to work. And so within all the different types of business protection disability plans, BOE is the one we're going to talk about because it reimburses the business owner for those business expenses incurred during a disability. You have your individual, your traditional disability policy that pays you, the business owner, your client directly. That's what they use to buy groceries, pay their mortgage. BOE then reimburses owners for expenses of keeping the business running. Attached to that, similar to that, is the business loan protection. So many of you may have taken out a loan to purchase a practice, maybe buy a building, buy new equipment. This is probably more for probably larger businesses, maybe who do have some investment in fancy equipment. If your office looks like mine, might just be a computer. But if you're a dentist, you may have to buy big dental chairs. I can't imagine they're cheap. So you can add this to a BOE policy and it reimburses you for loan payments that you have to make. So you have your BOE to pay for rent, expenses. BOE adds an additional option to cover business loans. Additionally, you could have key person disability benefits. If your key person becomes disabled, then the business can receive benefits from the policy to keep, hire somebody, retain somebody, bring in a temporary person, or disability buyout. So you can have disability policies that fund your buyout agreement. Probably more often than not, you're going to have the buyout agreement and there's going to be life insurance attached to it, because we think of that. If somebody dies, they have to buy out the surviving, buy out the deceased partner's estate, and usually fairly quickly, because they're dead, and you need the life insurance to complete that funding. Within that buyout agreement, there probably is also a disability component. And the disability buyout policy then can come in and help fund that as well. But going back to BOE, what does it cover? So I already said it doesn't, a little bit about what it doesn't cover, but it covers the expenses of what I call keeping the doors open, to having a place where if you're the primary mover and shaker, the income generator, that if something were to happen to you for a while, how do you keep the business going? It's kind of just to keep it treading water, have a place for you to come back to. So it would reimburse payments for rent, taxes, insurance, employee payroll, loans, again, if we had that loan protection rider. So imagine, and this is, sometimes you have an example and it just works for you. I always think of a dentist. Imagine there's one dentist in an office, has two hygienists, and somebody up front to answer phones and make the scheduling. If that dentist becomes disabled and is out of work for 6 months, 9 months, he has this individual disability policy that's going to pay him to pay for his mortgage and pay him personally. But then the BOE covers the expenses of keeping the dentist's office operating. It's not going to, now if somebody has to come in for a cleaning, the dentist still isn't there, but it keeps it so that the dentist can keep his office going. So when he returns, his employees are still there. He still has that space. He didn't default on his lease. So what's not covered? Basically, the business owner's income. So that dentist's income. It doesn't reimburse him for him paying himself a salary, but it will reimburse the salaries for the two hygienists and the receptionist person. It also would cover if the dentist hired somebody to come in and fill in for him. So lots of benefits there. Like I said, it's usually there to keep the doors open. Where a traditional disability policy goes to age 65, BOE policies usually have a 12-month, they might go 2-year benefit period. It's not designed basically to fund it so that the two hygienists would never have to work again and never, basically if the BOE policy would fund their salaries to age 65, then be no incentive to work. So it's usually a short-term thing, either to have the dentist get healthy, get back on his feet, have an office to come back to, or to have something that's sellable. So if I have a dental practice, I can't ever work again, but I have a staff, I have clients and all that, then there's something that probably could be sold to a new dentist. So you receive those benefits to cover in the operating expenses, the continuity. Like I said, there's that business value. If I already have an operating, functioning dental practice and I can't be the dentist, but I have all of those people to help fill in and somebody could buy it in and almost step right into my shoes, the BOE policy did exactly what it was designed to do. So CAT, catastrophic, or COLA, cost of living adjustments. So these are two riders attached to disability policies. What does the CAT do? Catastrophic disability benefits. So it's usually 2 to 3 triggers for this. And it's many times the same activities of daily living that we already talked about. Cognitive impairment like Alzheimer's, sometimes or loss of sight, loss of speech, loss of hearing. Things that we tend to think about when we think about people who are disabled. Not necessarily that I hurt my back skiing, and so I'm out of the office for 6 weeks because I'm in traction. Might call that a disability. This is really designed for those worst case scenarios. Sometimes I think of them as the bad car wreck scenarios where you may or may not be able to go back to work ever, and not necessarily, even if you could, may not be at your level of income. COLA, cost of living adjustment. So every year that the client is on claim for disability, the COLA rider increases the benefits every year that the client's on claim. So they get their $5,000 a month for 12 months. After that, then it's increased. So the $5,000 a month goes up to $5,100 a month for the next 12 months. It can be a fixed increase, often it's 3%. It can be a CPI. Some say it's CPI up to 3%. It's always going to be a compounding number. So just two features on top of a traditional individual disability policy. Another one is the residual rider. So it allows a partial benefit to be paid if client is able to work, isn't totally disabled, but still has a loss of earnings. And the SIS, just another acronym there that we like to throw in, social insurance substitute. You can add this to disability policies, fairly rare, because a lot of times you'll have SIS or basically the same SIS built into a group disability plan. And it says that if you get Social Security disability benefits, then your group disability benefits can be reduced. You can add this to an individual policy, and it does the same thing, but usually only to a certain amount. So you may have a $5,000 monthly benefit with only a $1,200 SIS. Couldn't do $4,000 of SIS. There's going to be some cap that the insurance companies look at and say, based on how much people tend to get or maximum they might be able to get from Social Security, we're going to cap it at this amount. QLAC, the Qualified Longevity Annuity Contract. There was a lot of interest in these 4 or 5 years ago when some of the tax laws changed that allowed people to do this. And I think it's still an interesting planning tool. I think a lot of people just don't like the idea of taking some of the money and putting it aside to receive future income later in life. You may say, if I'm going to do it, I'd rather get it now and get my next payment next month or in 30 days, rather than saying I'm going to defer it for 2 years, or what's most often here is at age 85. So let's take a look. What is a QLAC? Well, it's a single premium. Basically, it's a single premium and immediate annuity kind of chassis. And you can use up to 25% of the aggregate amount in your qualified accounts to a maximum of $125,000 total. So it's 25% of the sum of the qualified accounts, money in the qualified accounts, or $125,000, whichever one comes first. You can't use a Roth. But what it does is it creates a guaranteed income stream 2 to 30 or more years in the future, but not to exceed age 85. And a lot of these are often designed to start payments at age 85, where you look at someone and they're doing okay, but just in case you want to start some income at age 85 in case they have longer than average life expectancy. The payout options, they work very similar to an immediate annuity. Once payments start, you can get how they come, generally a life only. Payments start and will be paid for as long as you live, or have some sort of cash refund option. If I put in $100,000, start getting payments in 20 years, and I only get 8 payments for $20,000, then I'll get back, my beneficiaries will get back $80,000, the difference in what was paid in and what was paid out. There's no lump sum payouts, has to be a level or a monthly payment. The death benefit is usually a lump sum or income stream to beneficiaries. So again, you can build in a death benefit that says if I die before I start taking these, before age 85 or whenever the time is to start taking distributions, I can, but that's going to reduce my payout later in life. And the tax benefits, here's really what is interesting about these, and it's that the value that you put into a QLAC, that 25% or $125,000, is removed from RMD calculations. So it's a way to have people who maybe say, I don't need to start taking my RMDs right now, or I don't really want to. It's creating more income than I need right now. And is there a way to defer, sort of a way to be able to defer taking RMDs for a portion of my qualified money? So let's take a look here at Angela. She's age 70 and a half. She has $400,000 in her qualified accounts. 70 and a half, she has to start taking RMDs. And she says, you know what? I don't really need to. I've got a good pension. I am doing fine. I really, is there just a way I sort of want to kick the tax can down the road a little bit? I don't really want to start taking the money out right now. But if she does nothing, she has to take the RMDs on the full $400,000. What she could do is take $100,000, so that's the 25% maximum, and put it into a QLAC, which is, like I said, essentially a deferred immediate annuity. The $100,000 comes out of her taxable account, goes into an immediate annuity, or deferred immediate annuity, that will start paying her at some age. But because it's a QLAC, because of the way it was designed, now this year she only has to take RMDs on $300,000. You might say, well, it's kind of neat, but I don't know that that's enough. And that's obviously a client perspective. Reduced her RMDs by 25%. Sounds pretty good. The same time was reducing, moving it from 400 to 300. Did it move the needle enough? Can't eliminate the RMDs, but maybe that's a way to help. Who does this make sense for? Well, I would say it's for somebody in excellent health. And why do we say that? Well, you're going to defer income for a while, so you should at least be alive when you're when you're expecting to start income. And the longer you live, the more you get out of the annuity. So somebody who's not in good health, who maybe isn't going to make age 85 or isn't in great health and don't expect them to live much past age 85, it's probably not a great fit. Family history of longevity in the family obviously is a good indicator of some of that. Like the idea of that income later in life. I don't want to take it now, but if I get out to age 85 or get later down the road, I'd probably like to have some. There's a potential that the current investment portfolio will be outlived. Again, if I have $8 million in assets at age 70 and a half, the QLAC may not, again, move the needle enough to have it make sense on my qualified accounts. But for other clients, it may. And so that ability to say, even if I happen to not do as well and run out of my money, if things start to look a little shaky around mid-80s, this is something now that can help and make sure it's, that their money won't be completely outlived. And of course, need to defer RMDs. That's pretty much why you would do this, is the QLACs is to kick that tax RMD can down the road a little bit. ETI, so extended term insurance. This is non-forfeiture option built into whole life policies. And so when you have clients with whole life policies, this is usually around page 7 or 8 of the policy. And there will be different charts and different levels of numbers and things that you can see. And you probably wonder what some of them are. They're non-forfeiture options. That means if something happens down the road, what options do I have basically to get out of the whole life insurance policy? Usually going to be three options. One, the surrender value. You can cash it in. You can say, I don't want to pay the premiums anymore. I want to cancel the policy. Give me my cash value. So that's going to be one non-forfeiture option. Another option is going to be the reduced paid up. So it's going to take whatever cash value is built in, and instead of surrendering the policy and getting that cash value in a check, it's going to take that cash value and say, instead of X amount of whole life and paying premiums, how much whole life will this amount of cash value get that doesn't require any future premiums? So it's still whole life, but it's going to be a much smaller policy, but no future premiums. Again, the non-forfeiture says, I can't make the premiums anymore. How do I do something different? Option 3 is going to be extended term insurance. Same amount of life insurance that I had originally, or that I have right now, no future premiums, and it just says your cash value will keep the same amount of life insurance going for X number of years, Y number of months, Z number of days. So cash, surrender for cash value, I get all the cash, no life insurance. Option 2, keep it as whole life, it's less, but no future premiums. Extended term insurance, keep the same amount of insurance, but for a specified period of time, not my whole life. 2015, Roberto, age 47, he got a $50,000 whole life policy, and he was paying right about $1,200 a year for it. And so this was a policy that I'd reviewed for an advisor and a client, and just so happened that as we were going through this and looking at options for the webinar, we had the non-forfeiture options pages. And so I picked a date out in the future, 15 years from now, March 2nd, 2013. The policy says, based on the guarantees of the contract, now these can be better because there may be dividends and things like that, but in 2030, he would have the non-forfeiture option of cashing it out for $13,000, is what it is. No more insurance, gets that as a check. Reduced paid up, no future premiums, reduced paid up, no future premiums, $26,000 of insurance. So not $50,000, reduced to 26, no future premiums. That cash value gets him a reduced paid up policy. Or extended term, $50,000, that would go for about another 16 years through November 13th, 2046. I always like the extended term option because it's always so precise. See that it's March 2nd and it's calculated through November 13th. It's not like, March 3rd of the next year. It's, 16 years, 14 years. A lot of times it will say 7 years, 4 months, and 21 days. It's very specific exactly how long it's going to be, but it's the same $50,000 just for a shorter period of time. Future increase options. So these are added to disability policies that protect against changes in health. So when a client purchases a disability policy and is in good health, you can add these on top of a policy, and it allows you to increase the disability policy without any future medical underwriting, just financial questions. And there's two main types. I'm not going to go into all the nuances of them at the moment, but you have a stated dollar amount. So you may have a $5,000 disability policy. If you become disabled, it pays $5,000 a month. And it may have a $3,000 future increase rider. At any point in time, every year, as long as it's financially justified, meaning your income's increased, you can purchase some of that, you can exercise some of that $3,000 of future increase. So here in our example, my income goes up and I want to increase my disability policy by $500 a month. So my base policy goes from $5,000 to $5,500 per month. Next year, there's $2,500 left of my FIO pool. So as I use it out of that $3,000, it goes onto the base plan and it stays in, and it reduces the FIO pool. There's another option that doesn't have a defined amount, and it just says you're eligible for what you're eligible for based on your income at that time. And this one tends to be in every 3 years instead of in every year. And the trade-off is that it's more flexible, or it can be larger, but you have to take usually half of what you're eligible for. For the $3,000, the stated amount one, I'm paying for that so I can pick and choose when I want to exercise it. This one, no stated dollar amount, doesn't have any premium to it. And so it's really up to me to accept what I'm eligible for and apply for it every 3 years to keep it on the policy. FPO. Sounds a lot like FIO, but it's FPO. And it's a similar thing, but only on a long-term care policy. And the FPO is generally offered every 3 years, and it gives you the option, or the insured the option, to purchase 5%, 10%, or 15% of the original long-term care benefit amount. So it's the original amount. So it's not a compounding increase, but really more of a simple increase. So if I've been exercising it for 20 years, I start off at $100 a day, and I've been exercising for them for 20 years. When I get my next increase option, it's still going to be $5 a month, $10 a month, or $15 a month. It's that based on the original LTC amount. The costs for the new 5, 10, or 15% are based on the age of when the client exercises. So if they purchased the policy and they were 40 and are exercising the 10% at age 60, that new 10% or $100 or $10 a month is based on an age 60. But all the other premiums stay the same. All the other premiums are based on the age at which they were purchased or exercised. You probably haven't heard about this a lot because these are generally not available on new policies. Most traditional long-term care policies now are going to have fixed, just the regular compounding increase riders. You may see them on older individual policies your clients may have, and they're fairly common on group plans, and even on fairly new group plans. So you may see them more commonly there. The federal long-term care insurance plan, I believe, has it. So, again, for any of you who are working with clients who may be federal employees and you see it there, I know that at least as of 2017, that was an option in the plan. Guaranteed universal life, sometimes called no lapse guarantee. This is a life insurance policy that has a guaranteed death benefit that's fixed. It's designed to be based on the premium or cash value that goes in, and it's regardless of interest rates, cash values, dividends, nothing like that. It's almost like a term policy for life. As long as you pay the premiums and specified premiums, there's a lifetime guaranteed death benefit. And the design is that there's little or no cash values as time goes on. So sort of furthering my idea of a lifetime term policy. And it guarantees the policy will not lapse as long as you don't make any changes to the policy. And by changes, that could be not paying the scheduled premiums, it could be taking out loans, trying to increase the death benefit. But for the most part, we call them, sometimes I call them the set it and forget it type policy. For a 1035 exchange, it might guarantee $500,000. As long as no changes are made, that $500,000 policy will be there whenever the insured passes away. And we've sent out notes, and I think some of you may have heard me talk about this in Philadelphia last week, but the Columbus Life policy, here's a comparison of how the low load no lapse guarantee policy works. Unfortunately, this particular rider is not going to be available at the end of the month, but seeing how the low load design of this policy works, I think highlights low load policy sort of in general. And so if you look on the left-hand side of male age 62, preferred non-smoker, $125,000 1035 exchange would guarantee over $500,000 of lifetime death benefit. That's exactly what it's going to be for the rest of his life. Next closest, $416,000. On the right-hand side, female age 67 in the third best health class wants to make 10 annual gifts to maximize a legacy. And the Columbus Life policy has a death benefit of $421,000 compared to the next best being $309 and $308. ILIT. Now this one probably is more common than some of the others we've heard. ILIT, Irrevocable Life Insurance Trust. How does this work? Well, in life, it is separate from the insureds. The trustee establishes a trust with its own tax ID number and bank account. And so the trustee applies for life insurance with the trustee is owner. The grantors of the trust make premium payments and gift the premium payments into the trust. Then the trustee sends out crummy letters to the trust beneficiaries that says, this money's been put here. You have 30 days to do something with it. What they shouldn't and what they should do is nothing. And then because it sits there, then the trustee then pays the life insurance premiums on behalf of the trust. At death, so this death benefit inside of the ILIT is not included in the grantor's taxable estate. So it's estate tax-free and income tax-free. So it's a great way to transfer assets and to normally to create a legacy or leave a legacy. The trust is the beneficiary, so the death benefit is paid into the trust bank account, and then the trustee disperses the life insurance proceeds through the trust provisions to the trust beneficiaries. So a lot of details, a lot of things that went into that, but it's a great way to the ILIT helps protect against creditors, predators, and divorce, and make sure that the death benefit is there for the trust beneficiaries. So the pros, what are the pros of an ILIT? Well, the death benefits are removed from taxable estate. As they keep changing our estate tax limits, this is, becomes more or less of an issue almost every year. But one thing that doesn't change is for the grantors, and usually mom and dad, to be able to control from beyond the grave, protect spendthrifts, minor children, or type A personalities. What are the cons? Well, once it's gifted, it's gone. So there is some loss of control from the grantors to the trustee, because the trustee is the one who's in charge. So making sure that there's a good trustee, hopefully a younger trustee than the grantors. And there's costs for attorneys to set it up and doing the ongoing crummy letters. But for the protection that it offers, that may be pretty small. Number 18, LLIS. That's us. What do we offer? Well, we offer lifelong insurance service to you and your clients. ROP, return of premium. Used to see return of premium riders on long-term care policies, but it usually doubled or almost tripled the annual premiums. So it wasn't that exciting. I talked about it on ABC or asset-based care, the life long-term care hybrid options, 80% or 100% of the premiums in after day one or maybe after 5 years. Return of premium term, not commonly seen, but I think it has a good, some places where it makes a lot of sense, potentially in divorce situations. So let's take a look at Tom. He's divorcing. He's age 45. He's a preferred non-smoker. And as part of his divorce decree, he's required to keep $750,000 of life insurance for the next 20 years. So as a preferred non-smoker, he can pay $1,000, $1,087 per year, just for a traditional long-term policy. At the end of the 20 years, there's nothing left. And he'll have paid in about $22,000 a year, or $22,000 over the 20 years. Or he could look at a return of premium term policy. Premium's much higher, $3,550 per year, much higher. However, at the end of 20 years, if he hasn't passed away, if he passed away, his ex-spouse would get the $750,000 death benefit. But at the end of 20 years, he has to keep it. So at the end of 20 years, he will get back $71,100. Get back 100% of what he's paid in. And because it's return of premium, his cost basis is $71,100. So in 20 years, he can cancel the policy, get a check for $71,000, and it's tax-free. So he can pay the lower premium for term And that may fit. That may be a good way to go. But at the end of it, there's nothing there. Here it's quite a bit higher premium, but because he's required to keep it all 20 years, he can potentially get 100% of his money back. And if your clients have a return of premium policy, our recommendation is most likely to keep. Now, I looked at a policy for Eric M. a couple weeks ago. He's 10 years into a $750,000 30-year term policy. He's paying $1,365 a year. Now, a new 20-year term policy, because he's already 10 years into the 30 years, so he's got 20 years left, a new 20-year term policy was about $600 or $700. So the savings is pretty good. So if he were to do that, he's going to pay $600 a year for a new policy. If he surrenders it today, he gets about $682, about 5% of what he's paid in. But if he pays 20 more years into this policy, he'll pay an additional $27,000 in premiums. But in 20 years, he will get back almost $41,000. So if he surrenders it today, we save premiums, but he gets $682. If he keeps doing what he's doing, puts in 27, gets back 40 at the same time. So our recommendation was, if he needs more life insurance, add a traditional term on top of this. But because he's already done the heavy lifting of the policy, he's already 1/3 of the way in, to go ahead and keep this policy and finish it out. Lastly, number 20, notice of term expiring, which is sort of fitting. Our webinar is about to expire, so we talk about notice of term expiring. Terms do come to an end, like all good things. And so another thing that was requested by our advisors was to keep them and their clients in the know when somebody's 10-year or 15, 20-year term policy is about to expire. Because if we have, generally it comes like from the insurance company, it will be 2 or 3 weeks before the policy is over, which is not a lot of time to make any changes if needed. So our term comes a few months ahead of time. So we have time to make decisions. Do we want to be like Anna and let it go? Let it go. Or maybe convert to permanent coverage. Client's health has changed. Maybe they want to keep some coverage. Can they keep it as ART? Maybe they just need it 1 or 2 more years, and the ART renewal premium isn't that bad. But by doing our notes and giving 2 to 3 months of lead time, we have time to look at something new if needs change. Maybe somebody's still in good health and wants permanent coverage, or maybe just needs a new term policy. If we have 2 weeks, that's not a lot of time. If we have a few more weeks, we can look at applying for a new policy if needed. So please, for those of you who are at members of ACP, we will be at the conference in, wow, it's just about 2 weeks. How time flies here at the end of the year. And registration is now open at LLIS.com for our Insurance Academy. It's going to be February 20th through 22nd of next year, of 2019. And it will be at the same place we've had the last 2 years or maybe 3 years, on the beach here in Florida. Beautiful Clearwater Beach in Florida in February. I can't promise that it'll be warm, but I can promise that it'll be warmer than where most of you will be coming from. And for those of you who aren't familiar with us, we like to talk about our top 10, David Letterman, which I realize we may need to update this because as time goes on, fewer and fewer people know who David Letterman is. But our top 10 things that we do to help advisors are things like this: our monthly webinars. So we have 2 more through the end of the year. We're not your competition. Our only clients are fee-only financial advisors, and we work really hard to save you time and your clients money by doing things like pre-underwriting clients and situations to avoid surprises when they do apply for that disability policy or term life insurance policy. We provide advisor tools and client tools on our website. We're proud sponsors of a number of different fee-only financial planning groups. And we have specialists here in our office for different types of solutions to help you and your clients with. And as I mentioned in my talk, our APEs, our notes, our acronyms to help you and your clients manage your policies now and in the future. And Our last one, another one of my acronyms, ALIS. So an advisor portal we designed to allow you to have instant access to information about your clients, where they stand, annual statements, things like that, as needed. And so whenever you have questions about that, we're still here. Emails work great. We're still fully available for all of those different things. This is just one way, another way that if you happen to need the answer at 11 o'clock at night for a 7 o'clock meeting the next day, it might be available there. And since I believe I've gone over by about 2 minutes, thank you all for tuning in. If anybody has any questions, please feel free to email me. There's my email address. Give me a call. I'm happy to help with anything that you might have. Thank you all very much for tuning in, and hope everybody has a great rest of your week and a great rest of October.